You know that final hour of the stock market from 3 to 4 p.m. Eastern? It's a wild ride. It's this place where huge opportunities pop up, but for most people, it's an absolute minefield. Fortunes are made and lost in those last 60 minutes. But what if I told you that all that chaos isn't random at all? What if it's all part of a hidden playbook? It really is the million-dollar question, isn't it? The volume is massive, the moves are explosive, and yet somehow retail traders consistently find themselves on the wrong side of the trade, getting caught in these violent reversals just seconds before the bell. Why does that keep happening?
Well, the answer, believe it or not, is hiding in plain sight. It's right here, in the private notes of a professional trader. We actually got our hands on their playbook, and what it shows is that the final hour is a very deliberately laid trap. And it's not engineered by emotion or panic, it's engineered by the raw mechanics of the market itself. Today, we're going to decode this thing together. Okay, so here's the game plan. We're going to start by really defining what this trap is. Then, we'll look under the hood at the big institutional engine that makes it all go. After that, we get to the good stuff. How to read the order flow for clues, a pro's exact execution plan, and finally, the one rule you absolutely positively cannot break in the final minutes of trading. So first up, what exactly is the power hour trap? Look, this isn't some conspiracy theory. It's just a predictable structural conflict that happens every single trading day between two very, very different kinds of players. So on one side, you have this enormous, powerful institutional flow. We're talking mutual funds, ETFs, the real heavyweights. And on the other side, you've got retail traders chasing the momentum that all that big money creates. The notebook calls this the retail liquidity trap. And rule number one is simple: stop chasing. Because you're not just chasing a price, you're literally stepping in front of giant price-insensitive funds that are just trying to get their end-of-day business done. And to really get the trap, you have to understand the engine. That crazy volatility at the end of the day, it's not driven by breaking news or some sudden change in sentiment. No, it's driven by giant institutions that are forced to trade. Whether they want to or not, they have to. The real key to this whole puzzle is something called a market on close order, or MOC for short. This isn't a suggestion, it's a command. These funds have to execute these trades right at the closing price to minimize something called tracking error. So think about it. They don't care about getting a good price. They only care about getting the closing price. And that's what creates these sudden, incredibly forceful moves that seem to just come out of nowhere.
So what we're really seeing is this kind of three-headed monster. You've got the MOC orders we just talked about. You've got passive index funds that have to rebalance billions of dollars. And you have these big algorithms trying to hit the day's average price, the VWAP. The thing to remember is they aren't trying to trick you. They're just executing mandatory functions. Our job is to learn how to read their giant footprints in the market.
Okay, so we know why the market moves like a crazy person. Now let's get into the how. How do you actually spot these institutional footprints in real time? This is where the trader's notebook gives us the exact visual cues we need to be watching for.
And there it is, the whole setup, sketched out on one page. Now, I know at first glance it might look a little complicated, but I promise you, it boils down to just two critical signals that tell you the trap is being set. Let's break those down right now.
So this all comes down to two things. First, you're looking for what's called volume exhaustion. You see this massive push on huge volume that slams right into a key daily price level, and then poof, the volume just evaporates. That tells you the big guys are probably done. Second, you see the aggressive sweep. This is a large, forceful order that just plows through the market, and it seems to not care about price at all. That's your MOC order creating a head fake that sucks everybody else in.
Okay, so we've identified the trap. We can see the signals. Now for the most important part. The counterattack. See, the professional strategy isn't to join the chase, it's to trade against it. It's called fading the head fade.
This shows us that in the final hour, your clock is just as important as your chart. The real action kicks off around 3:30. By 3:45, the trap is usually fully set as those MOC orders create this big imbalance. But the sweet spot, the highest probability window for you to act, is in those few minutes right around 3:55 p.m. This is what the notebook calls the washout moment, just before the close. So here it is, the full game plan. The confirmation is when you see the price hit a key level, one that you've already identified before the day even started. The signal is that volume exhaustion we talked about. The fuel for the move is gone. Only then do you even think about the action, a reversal trade, like going short, aiming for a really quick snapback towards the day's average price. But, and this is crucial, Discipline is everything. Your stop loss has to be incredibly tight, because if you're wrong, you are stepping in front of a freight train with no brakes. We've covered the setup, the signals, the strategy. But all of that is totally useless without understanding the single most important rule in this entire playbook. And it all has to do with what happens the exact second the clock strikes 4.
This is why this matters so much. At 3:59 p.m., the market is incredibly liquid. The difference between the buy and sell price, what we call the spread, it's tiny. You can get in, you can get out, no problem. But at 4:01 p.m., the game completely changes. The market makers just pull back, liquidity vanishes, and that tiny spread becomes a massive, untradeable gap. Trying to get out of a position becomes nearly impossible without taking a huge loss. And that leads us to the final non-negotiable rule. It's written in all caps in the trader's notebook for a very good reason. Never hold a power hour trade past the 4 p.m. bell. The risk of getting trapped in that liquidity vacuum is just way too high. I don't care what your profit or loss is, you have to be flat when that bell rings. End of story.
So, you see, the final hour isn't just random noise. It's the echo of these giant, mechanical transactions playing out. You now have the playbook to see the setup, to understand the engine driving it, and to recognize the extreme risks involved. The only question left is, how is this going to change the way you see that final, chaotic hour of the day?